Stay informed on earnings trends and analysis in Zacks Earnings Outlook.
Well, we're getting ready to close the books on another earnings season, and that means it's time to check in with our research director, Shiraz Mian, who keeps tabs on the aggregate trends of the different earnings seasons.
Sure.
So when we began this Q3 season, it was expected by a lot of people who know about this kind of stuff, right, who watch this all the time, that the S&P 500 companies with higher global revenue exposure would do better in earnings and sales growth than those S&P 500 companies that didn't have this higher global revenue exposure. Did that happen?
Yes, it did happen. In fact, we saw this trend play out to some extent in the Q2 earnings seasons as well, but we really saw it play out in full force this earnings season. The improved global growth environment and the pullback in the value of the U.S. dollar was the big reason for folks arguing or forecasting what you described. And I have a slide that I want to show here. One of the things I have been flagging since the start of this earnings season, immediately after we had a critical mass of reports, that the momentum on the revenue front was really notable. And this is what I'm showing in this slide. Not only the growth pace overall in the aggregate shows a strong momentum relative to other periods, relative to Q2, relative to the 4-quarter average and the 12-quarter average, but a notably higher proportion of companies are beating revenue estimates as well. And the biggest explanation for that is what you described. And another proof of this is when you compare the results for small caps and large caps, and you don't really see the momentum to the same extent on the small cap side.
So what are the sectors that are driving that? Tech and energy, maybe?
Sure, yeah. So but tech, absolutely the most international of the major sectors. Energy, materials, industrials, the more global, export-oriented of the sectors. But tech really exemplifies it. The Apple, 12.2% year-over-year revenue growth. Facebook, 47% revenue growth. Google, almost 22% revenue growth. So energy, obviously, it's a global industry. Many of these major players are global. And then the growth rate in energy was also benefiting from unusually easy comparisons. And we saw to relatively less extent, but we saw the same trend in materials and industrials as well.
All right, so let's take a look at the big picture. We'll run down the Q3 scorecard.
Okay, so I have this slide. We have 462 S&P 500 companies have reported results already.
Okay.
For these 462, earnings are up 6.8%. Revenues are up 6.1%. 72.7% are beating EPS estimates, and 66.5% are beating revenue estimates. The comparison charts that we are showing on the screen, the left-hand side version is comparing the growth we have to what we have seen in other periods. The right-hand side chart, the proportion of positive surprises. You could see that the growth comparison isn't that favorable. And one major reason for that is that finance had a weak showing in Q3. If you look at the same growth comparison on an ex-finance basis, then we are tracking roughly in line with what we have been seeing in other recent periods.
All right. Well, other published data caught my eye as well since we spoke last.
You keep a close eye on this thing, Terry.
And I guess this kind of goes in line with recent past performance. The market this time around rewarded companies with positive earnings surprises less than average and punished those with negative surprises more than average. it seems, this
Yeah.
season. What would be the reason for that?
You know, I'll give my theory to explain that. And my theory is that when we were coming into the Q3 earnings season, the key factor that the market needed reconfirmed was that the positive or favorable trend we had started seeing on the earnings front overall in the aggregate over the last 3 quarters would get reconfirmed. And we did get reconfirmation of that, both in terms of growth, in terms of revisions, in terms of surprises. So the minimum that the average S&P 500 company is expected by the market is to beat EPS estimates. Every quarter, more than 2/3 of the companies beat EPS. So that's the lowest possible of the bars that a management team has to cross. And when they don't do that, when they are unable to do that, then there is punishment for that. Meeting it, exceeding it, this is what we're expected out of you. So that's the main reason. We were on a constructive, improving earnings trend. Any company that is not running in line with that trend will get punished. And another factor is that, which I'm sure runs in line with that same observation that you pointed out here. Earnings surprises, revenue surprises, and then the third key factor is guidance. So to the extent that the trend on the guidance front matched this observation, that'll be another contributing factor.
Okay. So right now as we speak, November the 15th, we're getting retail
That's
earnings.
right.
What story are those telling?
So I have a slide to share here with folks. 26 of the 39 retailers in the S&P 500 have reported results. And just a reminder to folks, we do have a standalone retail sector.
Yeah.
In our database. The official Standard & Poor's divides the retail sector into the discretionary and other areas. So for the 26 retail sector companies in the S&P that have reported results, earnings are up 2.5%. Revenues are up 9.1%. 80.8% are beating EPS estimates, and 61.5% are beating revenue estimates. I'm providing a comparison, the growth comparison for the retail that have come out. You will see very strong revenue growth over there, 9.1%, and that's I'm trying to isolate where the growth is coming from in the right-hand side chart, where I'm looking at the reported retail sector results on an ex-Amazon basis, and you will see that the revenue growth rate comes down. Our retail sector has the online vendors, then the traditional brick and mortar operators. We have had the department stores, we have the discounters, also the restaurants. So the online vendor results were very strong. Department store results turned out to be good as well, but not in terms of the fundamental improvement in their results, but more of how low expectations were. So overall, not a bad showing from retail as a whole, and that's what we are seeing in the numbers as well.
So right now you feel retail is holding its own?
Retail is holding its own.
On the aggregate?
In the aggregate, yeah, because the online space is steadily encroaching into the traditional brick and mortar space, and that growing pie, that growing slice of the retail space is growing at a much higher rate than the decline we are seeing on the brick and mortar side.
All right, bottom line, Q3, good, not
Very
bad?
Good. Yeah, no, absolutely good. As I mentioned, the key question coming in was whether the positive trends we have been seeing the last few quarters will continue, and the answer to that was yes. We got reconfirmation that those positive trends have continued.
So what do we have to look forward to for Q4?
So a lot of good stuff happening on the Q4 front, and here's what I'm showing is the, excuse me, the revisions trend to what's happening to Q4 growth expectations, and you would see that what's expected for Q4 today, November 15, as you pointed out earlier, is the same as what was expected at the start of the quarter, which is very unusual relative to what we have become used to seeing over the last many years. So very favorable trend on the estimate revisions front. We haven't really seen anything like this in the recent past. And when you look beyond Q4, you see that growth expectations I've pointed out all the 4 quarters in 2018, this growth momentum is expected to continue. So at least as far as earnings are concerned, the market should have plenty of fundamental support. One additional thing I want to point out is that all these expectations do not incorporate whatever Congress will do on the tax front.
Yeah, and earnings really haven't started reflecting that yet.
That's right. That's right. We don't have the actual legislation passed yet, and that's why the analysts haven't incorporated the impact in their estimates.
How long between the time it's passed and becomes law, if it does, to work its way into the results?
I would say just a few weeks.
Really?
Yeah. The analysts are all ready. They're watching it very closely. I am reading a lot of commentary from the analysts discussing what this provision would do, what that provision would do to their companies and their coverage. The moment the president signs the legislation, if it comes to that, we will see those changes reflected in estimates right away.
All right. I know you'll be watching it.
Sure.
We'll be talking again if and when that happens. In the meantime, don't forget you can always watch out for Shiraz's written commentaries on our website, Zacks.com. And generally puts a new one out every week during the reporting season. As we get into the end of the year, they may be a little bit sparser, but there's at least one new one coming out yet that I know about. So to get a handle on what he sees in the aggregate, in those written commentaries, just go to our homepage, Zacks.com. You can link to it from there. With Shiraz, I'm Terry Ruffalo.